Good morning, everyone. My name is Mark Miller. I'm a columnist on retirement. I write for Reuters, Morningstar, New York Times, some other outlets as well. And really pleased to be here for this first session, which is titled Retirement Security in an Era of Increasing and Disparate Longevity. And I think that title really struck me that it touches on two really critical issues within the realm of Social Security, which is, one is retirement security, which I'm going to loosely translate as adequacy of benefits, and then in an era of rising but disparate longevity. And we know, we all hear how kind of loose talk about how everyone's living longer, but we also know that longevity is not increasingly evenly across the board. So I think this panel really touches on two really key issues as it pertains to Social Security. And as somebody who's pretty passionate about Social Security as a topic within the beat that I cover, I'm often struck in doing reporting by the lack of public understanding of the key role that Social Security plays in this realm, in particular when we think about Social Security as this guaranteed lifetime benefit and the role that that plays as it pertains to longevity. And it's remarkable to see the role that Social Security plays as a longevity insurance platform, even across all different income spectrums. And even in fairly affluent households, we see that the guaranteed lifetime income benefit is really, really critical. So let me briefly introduce you to our distinguished panel members. I'm going to do that briefly because they're longer and very impressive bios that were included in your packet. But our speakers include Anthony Webb, who is Research Director of the Retirement Equity Lab at the Wharton Center for Economic Policy Analysis at the New School for Social Research. Breathe. Olivia Mitchell, this one's going to be even more breathing than required, who's a professor at the Wharton School, the International Foundation of Employee Benefits Plans, as well as a professor of insurance and risk management, business and economic policy, and the role I know her best in is the executive director of the Pension Research Council. I haven't covered even nearly all of that. And then Gary Koenig, who is vice president for financial security at the Public Policy Institute at the AARP. So each speaker will come up and present for about 10 minutes. We'll have a little bit of discussion up here and then plenty of time for your questions towards the end of the session, or the second half of the session, I should say. So Tony, why don't you kick things off for us?
Okay, now I have a PowerPoint.
Yeah.
Hoping is on here. Okay, well, thanks very much for inviting me. It's my pleasure to be here. Can you hear me? This is joint work with Teresa Giladucci, Wei Sun, and Michael Papadopoulos, who's in the audience if you want to raise your hand. So the US faces a retirement saving crisis, or at least it will do if I figure out how this works. And some work that I've done shows that over 1/2 of working age households are not on track to maintain their standard of living in retirement. So the question is, what do we do about it? So low earners face a special problem. They very often don't have access to a retirement plan. They face the prospect of working till very, very advanced ages if they are to hit their replacement rate targets. And for many low-wage workers, working longer isn't even an option due to ill health or lack of employment opportunities. So we came up with a policy innovation. And the policy innovation is Social Security catch-up contributions. And these are modeled on the catch-up contributions that you have the opportunity of making starting at age 50 in 401k plans. Workers would have an opportunity of contributing an extra 3.1% of their salary to Social Security, and this is 1/2 of the regular 6.2% employee contribution. There'd be no additional employer contribution. Now, the way it would work is that an employee would be given a 50% bonus to his earnings record for years in which he made a catch-up contribution. So that if a worker was making $50,000 a year and made a catch-up contribution, he'd be credited with earnings of $75,000 a year. If you had a worker who was making sort of a $200,000 a year, instead of being credited with the current maximum of $127,200 of earnings, the worker would be credited with earnings of $190,800. And AIME, annual index monthly earnings, the primary insurance amount would be calculated in exactly the same way as now, only based on the earnings record augmented by the catch-up contributions. So here's what I claim for our I claim for our plan. So number one, it exploits the progressivity of the Social Security benefit formula to target low-wage workers. We've calculated it's broadly actuarially neutral. It has almost no effect on the 75-year actuarial shortfall. The program benefits everybody. Well, not quite everybody. The only people who it doesn't benefit are workers whose earnings turn down a lot at very old ages, because their earnings at older ages wouldn't form part of the top 35 years. And it exploits the greater salience of saving for retirement to older workers. Now, what it can't do, it cannot alone get households to adequate replacement rates. We still need to work on the second tier. And it doesn't eliminate poverty. We still need to work on the social safety net. So here's a table that shows the impact of the program on stylized very low, medium, high, and maximum earners. And I'd like you to focus on the second row, which shows the extra income the worker would get. The low earner would get $119 a year, a month. The maximum earner would get $345 a month. Now, is $119 a month a lot or a little? It's probably not a lot to many of the people in this room, but it's a significant amount to a worker who's getting a benefit of just over $1,000 a month. If we look at the contribution to Social Security replacement rates, in row 5, we see that the low earners and very low earners are getting an increase of 7.2 percentage points, and the maximum earners are getting an increase of 3.8 percentage points. So is the program attractive? Now, one way of evaluating whether the program is attractive to a worker is to calculate the rate of return the worker gets on their extra contributions. And we calculated the annual real rate of return on the extra contributions for men and women in the 1965 birth cohort who were very low, medium, high, or maximum earners, and making an adjustment for socioeconomic mortality differentials. And the calculations are just for the regular retired worker benefits. They're not taking account of any spousal benefits. So they're understating the true rate of return. And the good news is that all of the numbers are positive. There's some of the numbers that maybe aren't great, but I don't actually think that matters. And the reason is that the calculations I've just done don't take account of the longevity value of social insurance. So we calculated the tax rate at which risk-averse households facing an uncertain lifetime would be indifferent between contributing and not contributing to the program. And if their break-even contribution, if their break-even tax rate is more than 3.1%, the worker is better off contributing. If the break-even tax rate is less than 3.1%, the worker is better off not. The good news is that workers in every income group at both assumed rates of risk aversion, men and women, have break-even tax rates of more than 3.1. So then our friends at Urban Institute ran the model through DYNASIM, assuming a 100% take-up. They calculated the share of elderly who had incomes of less than sort of a 200% of the federal poverty line. And as you can see, the federal poverty level. And as you can see, the program has a modest but a significant effect on poverty. It doesn't do much for those on the cusp of retirement, and that's why the impact in 2015 and 2025 is relatively low. The reason is that in 2015, obviously, workers haven't had much time to contribute to the program. So to summarize, I think the program works. All household types are better off participating. It targets low-wage workers. It doesn't increase the actuarial deficit. It doesn't suffer from the risk of adverse selection associated with allowing people to purchase additional annuities at the age of retirement, which is a policy that has sometimes been floated. The big question to my mind is, should it be a mandate? Now, the big risk with the program is the risk that the intended beneficiaries might not participate. Now, I am all in favor of nudging them, and I believe that nudging sometimes works. If nudging doesn't work, and we really think that the program is good for them, it would be in accordance with the traditions of social insurance to make it a mandate. The only real objection to a mandate is not the economics. It's the fact that what I've put forward as a voluntary purchase of a valuable additional benefit would instead be viewed as the imposition of a tax. And I'm out of time, and I thank you very much for your attention and for your generosity in funding this research.
Good morning. Is this working? Test, not working. Make it work. All right, here we are. So my name is Olivia Mitchell. Good morning, and it's a pleasure to be here with you. I decided to use this handheld mic so I could actually see my slides. And would you please put up my slides? I'm here to talk about a proposal that we have examined called Evaluating Lump Sum Incentives for Delayed Social Security Claiming. And this is joint work with my colleague Raymond Maurer from the Goethe University at Frankfurt. So the place where we start is that most Americans claim Social Security early, before their so-called full retirement age. Today, most people's full retirement age is heading towards 67. And what we know is that the majority of Americans, 90% of Americans, claim their Social Security benefits before their full retirement age. And as a result, they experience a lower benefit the rest of their lives. And that's, in fact, not necessarily desirable if you're interested in things like improving the poverty situation of older people. what we know is that claiming later boosts lifetime Social Security benefits. I was testifying recently, probably a year ago, before Senator Warren and some of her colleagues, and I said, did you know that if you delay claiming between 62 and 70, you get 77% higher benefits per month the rest of your life from then on? And she said, no, I didn't know that. So I was interested, and I'm spreading the word. You guys probably already know this. But of course, what you have is, depending on the claiming age that you have in mind, right now you would get a benefit that would be, how do we do this? 70% of your full primary insurance amount at 62, going up to 75, and that's a 7% increase. Basically, it's roughly between 7 and 8%, and this is where you get to 77% later. Now, if you also work and contribute more, then you may get higher benefits as well because of recalculation. But so this is a very important point, and what it suggests is that when people claim early, they're giving up this enormous potential big increase in lifetime annuities, which are indexed in real terms. So that's a big opportunity cost. So our previous work, and I cite some of it at the end, has asked the question, would people delay claiming Social Security if they got some of their increased benefits as a lump sum instead of as a life annuity? We know for a lot of reasons people are not very enhanced, or they're not very enchanted with life annuities. They tend to overvalue lump sums relative to annuities. And in our earlier research, what we've done is use some surveys in American Life Panel from RAND, and we've asked people hypothetical questions, and we've said, what are you going to do right now under the current rules? And we go through the PIA formula and tell them what their benefit is going to be if they quit at different ages. And with a slider, they can tell us how much, when they would like to claim. So that would be the baseline. And then with the slider, we also say to them, what if we gave you a benefit boost, not in the form of a life annuity, but in the form of a partial lump sum? And we find on average, people say they would quit, they would claim half a year later. There's a big difference across the population. The people who are currently expecting to claim as early as possible at 62 would claim over a year later. So all those people are not disabled. They would understand the benefit of claiming a year later. And so what we do then is take some of those behavioral estimates, feed them into DYNASIM's model. We don't do it. The Urban Institute people do it. And we produce some outcomes, which I'll summarize quickly for you in terms of system solvency, income, and assets. So to get a sense of how big the delayed annuity is, what we would do is, first of all, we look at the current system. And let's imagine you were someone who, under the current rules, would get a benefit if you claimed at 62 of $1,500 a month. If you claimed later, let's say at 67, you get $2,143. And that's basically an actuarially neutral adjustment. We can quibble about that, but that's the basic story. Now, how much would the lump sum be? So the way we structure the lump sum is you would always get, when you eventually claim, the original early benefit of $1,500 a month. But if you delayed claiming under the current regime, you get a monthly payment of $2,143. If you delayed claiming under the lump sum regime, you'd still get $1,500 plus a lump sum of $108,000. And by the way, if you waited till you were 70, you get $177,000 in change. So these are big lump sums, and not surprisingly, a lot of people think that they would like to delay claiming in exchange for those lump sums. So we feed these through the behavioral parameters, the estimates people would delay claiming, the early claimants would delay claiming the most, feed them through DYNASIM, and what do we see? So the first thing we see is how much difference would there be in average cash income for people 62 and over by sex. And on the left-hand side of the picture, we see what's called the payable benefit baseline. That is, what can be paid under the current tax revenue projections. And on the right-hand side, we have the scheduled benefits. That is, if somehow money were provided to be able to pay scheduled benefits, and we don't speculate where that might come from, and neither does DYNASIM, what would be the difference. And the red bars are male, the blue bars are female, and this is the percentage change compared to payable, percentage change compared to scheduled benefits. And so what we see is basically somewhat of an improvement in cash income for older people under the reforms, whether you compare them to payable or scheduled. We also see, and not surprisingly, when people have a lump sum, a lot of that money would be saved, and particularly for people in the lowest and the middle income categories. And whether you look at payable benefits or scheduled benefits, in either case, there's a big improvement in assets. And this is probably understated because of the special way that DYNASIM pays out Roth IRAs. So we assume the money goes into a Roth and it's paid out, and they don't use market payout rates. So I think probably this is an underestimate. And then last, we look at the impact on solvency, again, with payable on the left and scheduled on the right. So our proposal is the blue bar, and the yellow is the current law. And you see, you know, a slight increase in the deficit under current law, less of a change over the scheduled benefits, and this is over 25 and 75 years. But basically not that big a change. It doesn't, this reform doesn't change the solvency outcomes. It doesn't make them worse. It doesn't make them better, but it's a benchmark to see how we can do it. So by way of conclusion, the lump sum reform versus payable or scheduled benefits increases cash income for the 62 over for men and women. The poverty rates are basically the same. The assets are up for the low and middle income groups, and it doesn't really hurt system solvency the way we structured it. So we think it has positive consequences without costing the system money. We can speculate during the Q&A what might be some alternative ways to tweak this program, but the bottom line is this is a system where, this is a reform where you're giving people a reward, a lump sum for delaying claiming, not penalizing them or punishing them for doing something as many of the current reform proposals suggest. So with that, I'll stop. There's some references to some of our work, and thank you very much.
Good morning. Thank you. I got one good morning back. Who was that? Sorry. So this is joint work with Jason Fichtner, who's here, and Bill Gale. And we came up with what we think is a really good idea, and we're excited to share it with you. So Olivia covered the importance of delaying claiming retirement benefits, or what the impact is. And this, Olivia had a chart. This just shows you by, had a table. This shows you by chart what the implications are. And the bottom line is the later you wait to claim retirement benefits, your higher your monthly benefits will be for life. About 7 to 8% for each 1 year delay. And what I put up here is if you got a 2 year delay, you're talking 14 to 17%, 3 year delay, 25% increase in your monthly Social Security benefit. And as Olivia pointed out, many people are claiming early, well before their full retirement age. In fact, about half of women claim at the earliest eligibility age of 62. And for women particularly, because this leads to a decrease in their monthly benefit for life, and they live longer, this could have serious implications for their long-term well-being. So those two facts sort of drive the motivation for the idea that Jason and Bill came up and I came up with. One thing to recognize before I get into the details of that is there are obstacles to getting to people to delay claiming benefits. And so what I put up here are 3 of them. I'm going to focus on the first 2. One is that people can't afford to delay, right? So they need the money. So they claim benefits because they need to make ends meet. The other one is, and Olivia mentioned this, people don't want to give up a year of income, 2 years of income, Social Security income, to get what they perceive to be a small increase in monthly benefits. And the last piece up here is they may not understand how benefits increase. And this is why on this last piece, there are educational efforts to get people to understand that the longer you delay, the higher your monthly benefit will be for life. I know NASI had put together a campaign and put some videos and some information along the slogan was, I think, it waits to pay. It pays to wait, thank you. And AARP has done similar work, recognizing that it's a personal decision and delaying may not work for everybody, but if you can wait, you should delay as long as possible. Okay, so what we set out to do, given that backdrop, is we had a couple of goals. One is we wanted to facilitate 2 to 3 years of delayed claiming. That was our goal. But we wanted to do it without limiting access to essential income. So this comes back to the first point that I had on the previous slide. Some people need that income, so we shouldn't deny them income they need to make ends meet. The other goal we had is we wanted this to be self-financing within the Social Security program itself. So we did not want to increase the solvency gap. We also wanted to encourage longer working lives, and we wanted this to be fully integrated within the Social Security program or part of the Social Security program. Okay, so what we came up with is what we call Supplemental Transition Accounts for Retirement, or what we call, for short, we call START. And don't tell me that the T is at the end and it doesn't belong there. I get this from my kids too. They say, shouldn't it be STAR? I really wanted to call it START, so that's what we're doing. So let's get into a little bit of the details. Okay, so STARTs are mandatory add-on savings accounts, and they're funded through a 1% employee contribution and a 1% employer contribution on taxable Social Security earnings. So it's up to the taxable maximum. There would also be a government contribution of up to 1% for low-income households. And when I show you some of the results, what we assumed here is we had a 1% contribution, government contribution for married households that have adjusted gross income up to $40,000. And you could read some other things. Social Security would enroll people in START. This would be pooled accounts, and we can talk more about the details of those during the Q&A. One of the key things for our proposal that makes it different is this point. Individuals would be required to exhaust START assets before receiving Social Security benefits. The idea here, remember, is we're trying to enable people to delay claiming so that they have less actuarial reductions and they get a higher monthly benefit for life. So that is the key under this. One thing I would point out, it says up until full retirement age. So once you reach full retirement age, there are no restrictions on getting your START assets. So this only applies up to the full retirement age, and we can talk a little bit more about that when I get into the example. The other key piece of this is that START distributions can begin at the early eligibility age, but they wouldn't have to. People can elect when they want to start. And the benefit that you would get, so the distributions from your START assets would be equal to the Social Security benefit you would get if you had claimed early. And I'm going to make this more concrete by giving an example, which I think is next. Okay, so let's take the example of a medium earner with career average earnings, thank you, $49,000, 35 years of work. I picked someone whose full retirement age is 67, so they're turning 62 in 2022. Under current law, they would get an annual Social Security benefit of $16,000, reflecting actuarial reductions. Under our proposal, with the 1% contribution from themselves and 1% from their employers over these 35 years, they would have START assets about $34,300, and all these figures are in 2016 dollars. That $34,300 essentially allows them to buy 2 years and 1 month delay in claiming Social Security benefits. So what would happen is at 62, if they still decided to claim at 62, instead of drawing on Social Security, they would draw from their START assets equal to $16,000, which is what their Social Security benefit would have been, for 2 years and 2 months. When they turn 64 and 2 months, they get a higher benefit because there's a lower actual penalty. And that benefit would be $18,540. And that benefit is for life. The alternative is if they wait to age 67 and they don't claim benefits, as I mentioned earlier, once you reach full retirement age, you have access to your START assets without any restrictions. So in this case, they could get their Social Security benefit at 67. It was $22,000 or roughly $23,000. And if they wanted to, they could get a lump sum distribution from their start assets of $34,000. We have special rules for people on the disability insurance program because people who are receiving DI do not get an actual increase or do not get an increase for delayed claiming. So we do have special rules for them. Some of the rules are similar to the retired worker in the sense that they always have access to their full start assets at their full retirement age. We also require that if they're between the ages of 62 and their full retirement age that they have to draw their start assets first. But what we do is for the delay that they're buying, we increase their SSDI benefit that they would get by an actually fair amount. And one of the key other exceptions that I'll point out is if a beneficiary has a condition on the compassionate allowance list, they can always, at any age, get access to their full start assets. So let me just go through some the results really quickly. This shows the increase in percentage increase in cash income by income quintile. So one thing to point out here is it takes time to see the effect of this proposal, and that's because these are accounts that take time to build up. The other thing to point out is the bottom quintile, earnings quintile, benefits the most. Okay, one thing that I do want to point out in this last slide is that there are, what you saw in the previous slides, there are transition and cohort effects that are really masking the full impact of our proposal. So what this shows you is, this is just the numbers from the previous slide. So this is the horizontal axis is the lifetime earnings quintile, and this shows you the percentage increase in their income for all ages 62 and older. But remember, if someone is 80 or older, and this is for 2065, 80 or older in 2065, they're not going to have a full career of savings or access to their start account. So that mitigates the impact that we saw on the previous slide. Also remember, for those 62 to 69, these individuals will be transitioning. So they'll be receiving their lower benefit from their start account before they get to their full Social Security benefit. So if you just focus on those 70 to 79 who have access to the start accounts for their full career, the actual average increase across every earnings quintile is significantly larger. So for the bottom earnings quintile, our proposal results in an average increase in Social Security benefits, or average increase in income, not Social Security benefits, of about 15%. So just final thoughts. We achieve meaningful increase in retirement income without limiting access to essential income. It has good distributional properties. We also reduce the Social Security 75-year shortfall by 12%. And the way we do that, I didn't mention it, we tax distributions from start accounts and credit it to the Social Security Trust Fund. So we're keeping it within the system, and we're fully paying for that government contribution and then some. And we also provide financial assets to those most in need due to serious health conditions or death of a working parent or spouse. Thank you.
Thanks, everyone. I will kick it off with just one question while you gather your thoughts on questions you'd like to ask, and then we will go to your questions for the remainder of the time. And I'd like to start with a question about the behavioral aspects of this from the standpoint of beneficiaries. You know, we see, when you look at current behavior, we see relatively low levels of literacy around Social Security. I think that's demonstrated by the relatively low number of people who delay their claims. That's, you know, the evidence for that is that despite the fact that there are these large benefits to be had, few people do it. And at the same time, we have relatively low levels of available help to people to guide them through this process. We have, of course, people can interact with the Social Security Administration online, through, over the phone, in the field offices, but we're seeing ongoing cuts in the budget of the Social Security Administration at the same time that we're seeing soaring levels of enrollment as the boomer age wave progresses. So the capacity of the SSA to guide people through the decision process is lower. And so I'm wondering about all these ideas, which maybe this loops back to what you discussed, Tony, the question of mandatory or not. One way to go is to mandate some of these solutions. The other way, though, is to increase complexity of decision making. Do you want to do this? Do you want to do that? When we already see that people have a relatively low ability to deal with what, frankly, ought to be a simple decision. So I wonder if you could comment about the behavioral aspects of these ideas, any of you.
Very interesting. I've done a lot of work on financial literacy or the lack thereof, and so I'm very aware of what people don't know. I think
The known unknowns.
well, what I would say is that Social Security regulations are incredibly complex. It is not a simple
Right.
decision. And in fact, it's the most consequential, when to claim is the most consequential decision that most people make, financially speaking. Just in terms of framing, several years ago, some co-authors and I did a study on the often touted break-even analysis. And this is something that Social Security field agents used to use. They've been enjoying not to use this approach anymore, but over half of all financial advisors still use break-even analysis. And it works very quickly like this. Imagine you were going to get $1,500 a month if you claimed at 62. Well, if you delayed claiming by 2 or 3 years, you might get $1,700. I'm just making up the numbers. But then what the advisor will say is, do you realize that if you delay claiming by 3 years, you are foregoing 3 years of benefits plus the interest foregone on that, and you would have to live 14 more years for sure to know you're going to get your money back. And people say, oh, I might not live another 14 years. And so what we have shown experimentally is that presenting people with this break-even analysis encourages, if not biases, people in terms of early claiming. So I think there's a huge job that we have to do in terms of educating the advisors as well. And I've heard financial advisors from the private sector say the exact same thing, that break-even is the way to think about it, and it's not.
And yet the advisory space deals with more affluent households. Relatively low numbers of households use a financial advisor, and the ones that do are more affluent. So there's still the broader question out there of how you guide people through complex decisions further down the income scale.
Well, I think it's also helped, and there are experts in the room that know about the Social Security statement that people got for a while and then didn't, and now we're getting them again. And the fact is that, if they show you your benefit as of your full retirement age, or even ideally as of 70, that would be much more beneficial in terms of encouraging people to delay claiming than saying, oh, age 62 is your benchmark.
Right.
So there's a lot that we've learned in this field.
Yes.
So I agree that more can be done, but part of the reason for our proposal is that even with educational efforts, they will likely not succeed to the extent that we would like them to. And so what our proposal, while on one perception, it could add some additional complexity in decisions, it really depends how it's presented. If it's presented as part of the Social Security program, it could be somewhat seamless. And that doesn't mean there's not some decisions that would need to be made by the individuals, and Social Security Administration would have some additional responsibility in terms of educating folks about it. But a lot of it is in the design, and I do think part of the reason why Jason and Bill and I came up with our proposal is wondering whether how far education can go. We think it can help, but we think more needs to be done.
But you would not be mandating this?
Ours
as
is
a choice?
absolutely a mandate.
Oh, it is mandated?
Yeah,
Okay.
we don't think it works. Ours is part of Social Security, which is a universal social insurance program, and we think that's how it works best.
Okay. Tony, did you want to comment on this?
Just endorse what Olivia said. So I would just endorse what Olivia said. I think she's summed it up very well, and I have nothing to add.
Okay, let's go to, that's a time saver, so let's go to questions from the audience. Bill, do you want to start?
Yeah, question for Anthony.
Can you all hear from in the back? Oh, you got a mic coming. Bill, hang on a second.
Thank you. Question for Anthony. You ruled out employer contributions. Did you consider making them optional so employers might look at this as a 401k match and want to contribute to it as well?
Right. We ruled out a mandate on the ground grounds that we didn't want to make the employment market for older workers. Sorry, is it turned on? We'd ruled out a match for we'd ruled out an employer contribution on the grounds that we hadn't wanted to make the labour market for older workers even harder than it already is. But speaking to your idea, the idea of an employer match is a very good one, and it's something that we'll definitely think about.
Tony, one thing I wondered about that was related as I read your proposal was whether higher income households wouldn't be better off simply putting money into a 401k with respect to the progressivity of your proposal, because you're saying it's more beneficial to the lower income bands.
I'll offer a somewhat technical answer here. If we have a higher earner who at the margin is investing at least some of his 401k wealth in bonds, then that worker would be better off substituting his catch-up contributions for his bonds. If the older worker is at a corner solution and investing 100% of his 401k wealth in stocks, the worker would not want to participate in the catch-up contributions.
Very interesting. So that's the sort of the annuity secret sauce, if you will.
Yeah.
Okay, gotcha. That's very interesting. Another question?
Thank you. My question is for Gary on the START accounts. You said that they would be professionally managed, which I assume means they would be invested in some stock, bond, whatever portfolios. Did you evaluate if there is a point at which that investment might a loss in the stock market or the bond market might affect the account to the point where it was actually be a disadvantage rather than an advantage?
So one thing I should mention is these are professionally managed. We don't allow the individuals to choose the investment. This would be an independent board that would decide the investment profile. The one nice thing, property of our proposal, is so given that individuals aren't choosing the investments, is that even if you have a downturn in the market and the account goes to zero, the individual ends up getting their Social Security benefit. And that's part of the reason why we did not want to allow individuals to select the investments, because they may take very risky investments, realizing that if they have nothing in their start assets, they could still get their Social Security benefit at the reduced rate.
Hi, Ted Goldman with the American Academy of Actuaries. First, all three are really interesting examples, and I'd like to compliment you on those. My question is, they all require additional funding into the plan, and we know that at some point we're going to have to address the shortcomings of Social Security as it stands today. How do you reconcile the additional costs with what, one of the options will be to increase contributions to maintain current benefit levels? How would you see this being, would this be in lieu of that? Would this be in addition to that? How would you align that?
So I'd just like to take the first stab at it, which is our proposal does not in fact require any, it doesn't change long-term solvency. So the fundamental problem is Social Security is facing big insolvency because the revenues from payroll taxes are insufficient to meet scheduled benefits. And I would actually go back and just slightly put a footnote on what Mark said earlier. You several times said these are guaranteed lifetime benefits from Social Security. That's wrong. It has been shown over and over again in the past that the scheduled benefits are not guaranteed. You can change the retirement age, you can change the taxation of benefits. So it's political risk, and we have to be very aware of that. And that political risk is fundamentally there. It's not made any worse by our proposal. It is true that we bring forward in time some of the benefit payments because people get lump sums. And so even over a 75-year period, there's not much difference. And obviously, in the long run, there's no difference. It's just, it's sort of like talking about the 10-year window so popular in Washington for tax reform purposes. I think that's not the right way to be running Social Security, to have a fixed end. But be that as it may, our system doesn't change solvency. We could talk about how to improve solvency, but I think it's a separate issue.
Yes, I'd like to sort of follow up on that. So our plan doesn't affect solvency. It has a negligible impact on the 75-year solvency. But if you want to get people to voluntarily participate in the catch-up contributions, they have to be confident that the program as a whole is solvent. And that's an argument for fixing the 75 shortfall, the 75-year shortfall now, rather than kicking the can down the road.
I would just point out that our proposal closes 12% of the solvency gap. But that obviously more needs to be done, and I think our proposal, though, fits within the broader context of reform. Again, and for our purposes, what we were trying to address is the adequacy of benefits without affecting solvency.
And so just to clean up my sloppy language, Olivia, would promised benefit or scheduled benefit be the better term?
It's the term of art.
Okay. But we've never seen changes in benefits paid out to people past the point of retirement. We've seen changes in scheduled benefits due to, say, the 1983 reforms.
There was a delay in the cost of living, which was part of the 1983 amendments. I remember, I think it's Wilbur Cohen, was that his name? From Florida, and he said, it was Claude Pepper from Florida. He said, there will be no benefit cuts over my dead body. And yet when the cost of living was delayed, that's a benefit cut. And he continued to live for another several years thereafter. So yeah, it happens. And
Right.
the taxation of benefits, subjecting 85% of benefits
Right.
to income tax above a certain AGI, that's another form of benefit cut.
Right, or if we implemented chain CPI, arguably would fall into the same
We
category.
can discuss that
Okay.
offline.
Okay. Another question.
Hi, I have a question for Gary in terms of the start accounts. Would you consider pegging it to like you have to get into this account at a certain age? I'm just thinking from an entry level, fresh out of college worker. Me personally, I'm already not contributing as much as I can to my 401k. This extra 1% to me looks like another pay cut, and now I have to budget a little more and do something else that is a mandatory.
We didn't put in an age start date on this because we wanted the effect of compounding over many, many years. We decided on the 1% employee contribution because we thought that was that with the employer 1% contribution and the government contribution for low-income households would be enough to reach our goal of getting a 2 to 3 year delay in claiming benefits. I think there could be a conversation that we can have along the lines of whether this proposal and contributing 1% to this proposal is better than contributing 1% to a 401k, because what this proposal does, it really uses the Social Security system, and what's best about the Social Security system, which is longevity risk, protecting against longevity risk, market risk, inflation risk, that might be a better place for your 1%.
I guess just a thought on that. We know half the workforce has some kind of retirement plan, 401k, 403b. A few have defined benefit. So there may well be some crowd out. And so that was one question that I would like to pose to you. And then the other question I have has to do with the view that 1% might be contemplated as advice. So we know when employers put in a default contribution rate in their 401k world of, let's say, 5%, people tend to contribute that because they think, oh, well, that's what the employer believes is necessary, and I'll do that. When we know, especially in the low interest rate environment, that you're going to be needing to contribute 25% for your own retirement in a pension separate from Social Security. So I'm a little bit worried about the 1% being taken as guidance. And I know you have a different objective, but what about the behavioral response?
So just quickly on the crowded out, the figures that I showed you are very under the conservative assumption that individuals reduce their other employer contributions, their 401k contributions, dollar for dollar for start contributions. So we also had it where we did not have any crowd out at all, but what I showed you was 100% crowd out. And when you don't have any crowd out, which shows you the bound, what I showed you, and that gives you sort of the boundaries between the potential effects, it mainly impacted the higher earning quintiles because they're more likely to have access to a 401k. Your question about advice. Oh, yes. I think this comes back to what I said to Mark, which is it depends how this is packaged. So we refer to this as a start account, but we very much view it as embedded within the Social Security and as part of the Social Security program. So it could be messaged that way, right? That this is just part of the Social Security program. And from that respect, if you did it that way, I don't think we have the issues that you raised.
Another question. I think we have time for one or two more right here. For a microphone floating around somewhere? Oh, you've got it. Great.
Hi, I'm Christina Fitzpatrick with AARP. I have a question for Tony Webb. You talked about the point at which people are indifferent between participating in this, making these extra contributions and not. I'm wondering if that is different depending on people's expected life expectancy. Projected life expectancy. So we've heard a lot in the past couple of years about how there are differences and those differences are widening. So have you done any analysis by race and ethnicity, and is there an effect for based on life expectancy?
Yes, we did. We had the mortality risk vary with income. So being technical, we used life tables varying with education that were done by Brown, Liebman, and Pollitt. The very low and low income workers were assumed to have the mortality of people with a less than high school education. The medium worker had a high school education, and the high and maximum earner had the mortality appropriate to a college education. Now we didn't allow for variations in mortality risk beyond that. We didn't assume that maybe some person knew that he was really, really healthy and lived to 100, and another person knew that he had a family history of some dreadful disease that would kill him when he was young.
One more question, I think we have time for. Is there another one here? Right here?
Thank you. Hi, Pamela Causey from the National Committee to Preserve Social Security and Medicare, and thank you so much for your very interesting presentations. I do have a question in terms of the START accounts. You have described them as add-ons, and add-on accounts generally tend to give a shudder in the advocacy community when you're talking about Social Security. You know, the general thinking being that is sort of the camel's nose under the tent in terms of bringing in private accounts, diverting funds that could be, you know, plowed into Social Security and building the benefit in that regard, which would certainly, even if someone was filing at an earlier age, you would think that having the employer and employee kick another 1% in on their FICA, that would give them a larger benefit even at an early age. So how do you counter a concern about bringing in that add-on component, which can make a lot of people pretty nervous when you're talking about the overall future and stability of the Social Security program?
That's a great question and something that we have thought about. One thing to make clear that this is an add-on, it's not a carve-out. And the one thing that I would say about our proposal, and the reason why I think it's fair to say that we like it so much, is because it's really putting more on the Social Security program. It's really elevating the Social Security program to do what it does best, which is to protect against longevity risk, market risk, and inflation risk. And the way you do that is by getting people or providing them a way to delay claiming Social Security benefits. That is the key.
We have time to squeeze in one more question, if there is one. Absent that, I have one more for Olivia that I was not going to ask, but now I have a minute. I wanted to ask you, Olivia, about the lump sum from the standpoint of the trade-offs of, we know that if you look in the world of private section pensions, when people are offered lump sums, they take them. But that's then detracting from what I'm going to be very careful with my language now, with that, the lifetime annuity feature, and the longevity insurance feature of an annuity payment. And I'm wondering, and we're seeing a lot of talk in the private sector pension world now about how do we do more to annuitize 401ks, for example, because recognizing the benefit of that lifetime annuity. How do you balance that goal with the notion of letting people take a lump sum instead of the delayed annuity payout?
Well, in the Social Security context, the vast majority of people don't delay.
Right.
So, I think the idea is to try to get them to delay. They're not going to do it for an annuity the way it's currently structured, but people tend to like lump sums. Now, we didn't recommend completely lump summing out the benefit because there's the concern that somebody will go blow it in Vegas or buy a bass boat or whatever. And yet to be able to encourage, without seeming punitive, to encourage delayed claiming, the lump sum can be very effective. Now, I've certainly never been an advocate of 100% lump sums, and I think a lot of people today are taking lump sums when they're feasible from their defined benefit plans because they don't believe their plan will be there in the future. And in the background, there's been a lot of discussion about how poorly funded the PBGC is. And the PBGC is not going to be able to pay for your lifetime benefits either. So if you work for a company where it's a very underfunded plan, I can understand why you might want to take the lump sum. Having said that, I've also been doing some work recently on how to integrate a deferred annuity into a 401k plan. And what we've shown is that if you have a certain minimum amount of money, doesn't pay to annuitize $5,000, but let's say you had $60,000 or more in your 401k plan, then it would pay to take 10% of the assets at age 65 and buy yourself a deferred annuity, which would kick in at age 85. And that can dramatically enhance your retirement well-being without putting all of your money into an annuity, which people don't want to do. So I think we have to think more creatively about new hybrid products.
Mm-hmm. Fascinating. Okay. I think we're out of time. That's about all the time we have, so please join me in thanking our panelists. And I'd like to turn it over to Jason Fichtner, who is going to moderate session 2 on improving benefits for low lifetime earners.